Welcome to this video. Will Sebastian here. I'm just going to do the pound AUD, and with good reason. You've seen a drop off from today post Australia data last night. Really a nice move. We mentioned it short. We mentioned it more or less somewhat as a market maker stop. You know, you come up here, you would have had a lot of stops taken away, and then you get that follow through, you get that momentum. Now, it just so happens that the momentum brings you to this level, okay, where this candlewick just exists. Okay, so prices come up here previously and fallen away. If you look at the longer term trajectory, this kind of perspective since the summer, you can see now really you're getting a bit of a match with your pound AUD, a little bit like you had previously. As many major economies look to unwind their cycle, you get a fair match between them. But at this point, we just know from the Bank of England that they're looking to hold in the December meeting, I believe. And obviously, like I said, last night you had Australian employment data, okay, in above forecast, unemployment rate below forecast. So a mixed bag slightly, but you're seeing really more or less AUD strength. Okay, that's what's followed through. You've got the same on your other Antipodean, which is the New Zealand dollar. But the point of this video really is to get you to understand, because this is a cycle I'm in myself. Now, you would have watched likely many other videos I've done. I usually hedge for income. To basically protect any positions I've got wrong. And that's relevant now, because if you look at this swing, okay, so you suddenly get a lot of AUD weakness on more dovish bets for the RBA. And at the same time, you get a lot of pound strength through there. So that translated to a really quick move of 860 pips, literally in Monday the 25th, all the way to, I can't even see it, all the way to the 11th of December. So 30 days in November, as the rhyme says. So you've got 16 days. Some of them are going to be weekends. So really a very short amount of time. So if you were shorting this, let's say you had a short here, that might still be out the money, okay, if you didn't use a stop. Because if you did use a stop and you kept shorting, you'd be wrong, over and over again. That's why for me, I don't particularly use stops. But you can see now what's happening is you're falling to this point. Now, you've already had a little bit of kickback in the day on a minute time scale up to here. That would have brought early hedge gains. And you got the choice. The price action looks weak. So you might not hedge, you might not protect. But even if you did, you're getting some insurance on the former fall. Now, if you don't hedge there, you might decide that you want to hedge here. Okay. So you've got all these opportunities essentially to take profits on any move back to the upside, which might follow, the general sentiment case, especially after you've just had, news out the Bank of England. So whether it's hedge zone 1 up here or hedge zone 2, like I said, you're basically insuring yourself because you don't have to close this short you got wrong, okay, or wherever you short it around there. So you might have a short out the money, but there's a fair chance that, the pound AUD won't just crumble all in a day, and it's looking weak, but it is stalling a little bit. And you could have taken hedge gains already on it to start with. Okay. Some people won't even hedge at that point. They'll just wait to see if you get down here, because the loss on this initial entry isn't great enough for them to worry about hedging straight away. So you've clearly got a decent system here, because in many cases, the price will, sort of continue doing something like this. And you don't get that immediate fall. And even if you do get it, you would just repeat the process in reverse. So you would exit this short, and then you would hedge short on your way down. And it tends to work very well on Forex markets because of, like I said, you end up with periods inevitably where it looks like this. And there's enough sideways movement and enough sort of trending. It doesn't have to be sideways. It can be a trend like this, for example, down, or a trend like this, up. Okay. There's enough ebb and flow, as we call it, movement for you to get in and out and in and out and in and out and collect profits on the way, on counter to your former position. Okay. So for me, a great hedge zone I've already taken advantage of was that one. Okay, so shorts wrong down here, we'll color them in red, but nonetheless, pulling back to this area allowed me to get a very decent hedge. I didn't want to hedge at this level because that level was too close to the original high, which was this one at the time. So I got a good hedge there. I got a good hedge on the EuroAUD, and I was out for gains on a push back to the highs. Okay. Now I can decide, do I want to lightly hedge? And then, of course, if we do get a rebound, exit at the highs again, or do I want to hold off? And generally in the long-term market, it doesn't matter because I'm collecting enough gains over time. My hit rate is high enough so I can afford to hedge to protect my positions because I'm going to be right enough to cover any loss. So instead of using a stop loss, more or less what I'm doing is I'm accumulating gains on one side whilst the trend goes against me and then using it to extinguish former shorts. All right, so ultimately I'll be able to kill this one and I'll have a net overall gain position. And then, of course, if I've taken a hedge here, all right, and it's wrong, let's say it pulls there, I've got the choice, do I want to buy again and perhaps exit for DCA gains, or do I want to simply, short a pop, for example, and then exit for gains there, and then it pops up again and I can kill that off and no loss. I can exit, I can reshort, I can do whatever I need to do to continue through the market. I would say the main basis for understanding this is, like I said, if you're looking at most major Forex pairs, they will have enough ebb and flow for you to do this with a general sort of risk approach. Whereas with yens, for example, or gold or oil, the SPX, whatever it may be, you need to deviate those sizes because the swings can be much more vicious and therefore there's going to be less hedge opportunities. So you've got to vary if you're going to be doing this. But that's a good bit of insight and a real example, if you like, because, it could be the case you fall straight back down. Like I said, it's not going to matter. Or alternatively, you could see something where you end up doing a bit of this. But either way, because of the nature of currencies, they're not just going to sort of dump 50% in a day or things like that, like crypto would. You get enough of that movement to take gains on both sides, and trading both sides is more profitable. Thanks for watching, guys. Hope that helps. As always, see you in the next one. See you there.